Bell on Wall Street, and now it's Market Domination Overtime, giving you all the moves to get you up to speed on the action from today's trade. Lou Bassinet is with us, along with Yahoo Finance's Jared Blickery, to break down the moves today. Jared, my friend, let's start with you on that close.
Yes, we had a little bit more action today than we have in some of the previous days this week, and you put it all together, S&P 500 has closed at a record high every single day this week. Here's the 5-day total, up 1.26% right there. And check it, oh, that was a Dow, excuse me. We'll get to the S&P in a second. Here's the Nasdaq, up 1% over the 5 days, and here's the S&P, up every day this week to a record 1.5%, rounding to the upside. And finally, here is the small caps, turning in a performance of just under 1%. You can see the highs were made on Wednesday there, and a drop into Thursday almost caused a close to break even, but we have rebounded since then. And just looking at the bond market, I'm not going to spend too much time on this, but we did close down 2 basis points on the day, well below that 4.5% mark, and the 30-year well below the 5% mark that we've been talking about recently. And the U.S. dollar index putting a little bit of pressure on commodities and crypto. We saw that trend up over the last 2 days. Again, this is a 5-day look. And checking out the sector action, we'll look at today, where materials ended in first place, up 1%, 1.17%. Industrials up almost 1%. Same for consumer discretionary. Financials and healthcare also outperforming. To the downside, we have communication services as the biggest laggard there, down about 1%. And for the week, let's check this out. Healthcare in the lead for 3.5%. We haven't seen a lot of that recently. Healthcare has just been underperforming the general market for years, for that matter. Materials is number 2, up 2.4%. Industrials, real estate, and financial, each of those up more than 1.5%. But you can see there, everything in the green this week, so pretty bullish end. This is also a 5-day look at the Nasdaq 100. You can see Tesla down 4%, Google up 4%. But let's take a look at what happened today, how we closed out here. Tesla up 3.5%, and Comcast down almost 5%. Intel, after earnings, down 8.5%. And we did see a few outliers today, but not seeing a lot of big movers to the upside or the downside. And we'll finish here on the Dow, where we have J&J down 0.7%, despite some of those leaders in healthcare this week. Amgen also trading to the downside, but McDonald's and American Express and Caterpillar, Goldman Sachs and Nike and 3M, all of those up more than 1% today. Back to you, Josh.
Thank you, Jared. So Lou, want to get your thoughts on this close as well. What'd you make of the trade today?
Yeah, green all around. I mean, every sector, it's pretty amazing. I mean, you and I have lived through market cycles where there's a lot more volatility in red. I think you have to fight the natural tendency here of going, hey, we hit all-time highs every day this week. That means we must be ready for a pullback. The reality is, in big bull markets, I mean, I think that puts us at maybe 20, just under 20 all-time highs this year for the S&P. There's years where we get 60 to 70 all-time highs in the year. So I know the tendency is to think it can't keep going higher, but I think the pull is that way, and I think it's over-optimism on getting the EU trade deal done, on getting China at least closer to the finish line, or at least guarantee that we're going to kick the can down the road for another 90 days so we can see what the impact of tariffs are. And I'd argue that the further out we get before tariffs really hit, the more we're going to benefit from deflation from AI. So I think there's a strategic move here of counterbalance the tariff impact by really letting AI kick in and bring productivity.
AI productivity. Yeah. Let me get your thought. I was talking to Adam Johnson this week, and you know Adam.
Yeah.
And I asked him, listen, do you want to book profits at this point? I mean, such a big move, Adam, off that April low.
Yeah.
And Adam said, no, I'm not booking. I'm staying long. And I said, okay, why? And he said, well, it just comes down to the 3 E's for me. He said, earnings, employment, economy. As long as they're solid, I'm staying long in the market. What do you make of that viewpoint?
Yeah, I actually have to agree with him. It's not because we're friends. My 3 E's would be earnings, earnings, and earnings. For me, that's always what matters. And so I'm looking at those names that are trading at a low earnings multiple that are still reporting really strong growth. So I look in the semis. I don't love NVIDIA. I own it, but I don't love buying it here. I don't love Palantir. I like a name like NXPI that's trading at like 19 times forward earnings, more attractive. Looking in the biotech sector, companies like Halozymes that are at 12 times earnings that are more of a pick and shovel play. So yeah, I don't think there's anything that gets in the way of higher prices from here, but I don't think that's a justification to just chase momentum and just pay any price for it.
What about big tech earnings next? We've got a lot of big names who are reporting. Some of those names have made already big moves like you're talking about. How closely are you watching those reports? How important? What's sort of on the line with those reports, Lou, in your opinion?
Yeah, I think after the report from Alphabet this week, I think everyone can breathe a sigh of relief, because the read-through is that
It's
cloud's
solid.
Yeah, the
Yep.
cloud's going to be really strong for
Ad
Amazon.
market holding in.
Yep. Microsoft's cloud's going to be strong. AI growth, and everyone's okay with increased CapEx expenditures on AI, right? Like, go back 2-3 quarters ago when Meta's like, hey, we're putting everything into CapEx on AI, and everyone freaked out.
Yeah.
Now everyone knows there's about a 2-quarter lag to see the profitability and growth come from those investments. So for me, I think the focus is really on Apple. Does everyone turn a blind eye to it, kind of like they did with Tesla? Like, everyone expects a weaker report. They're really a laggard in AI. Does that really follow through?
It's been beat up already this year. I mean,
Yeah.
do you look at an Apple and say, okay, that bad news is now priced in?
I think it is, but I think this is a story that has some time to play out, that's got to prove itself, right? Apple has to show that they can become relevant in AI. And I'm a longtime shareholder from like $50, split adjusted price. So, I think anyone calling for Tim Cook's head is a little bit aggressive. I mean, he's engineered what no one thought was possible after taking over for Steve Jobs. But I do think that people need to start seeing, where's the demand going to come from? What's your strategy? And let us see it play out in AI.
And we'll see what they have to say. Meanwhile, as the S&P 500, the Nasdaq closed at fresh records. We're getting more on the market action with Morningstar Chief U.S. Market Strategist. That would be David Sekera. David, great to see you, as always. Another close here, David. Another close. Green all over the screen, David. So I was just talking to Lou about this. Looking ahead, we just keep kind of melting up here, David. What are your expectations?
Unfortunately, I think the market right now is probably getting a little bit overextended. When I look at our valuations, the market overall is trading at about a 2 to 3% premium to a composite of our fair values. We cover over 700 stocks that trade on U.S. exchanges, so we compare our intrinsic valuation compared to the market capitalization. And a 2 to 3% premium may not necessarily sound like much, but when I look at our valuations going all the way back to 2010, less than 20% of the time has the market traded at this much of a premium or more. I just think the market in the short term has just gotten to be a little overly complacent, starting to see some signs of excess speculation, meme stocks starting to make a comeback, short squeezes. I actually just heard about a resurgence in SPACs. We haven't seen those for years at this point. An increase in call buying. So in my mind, it's still market weight overall. I think positioning is more important than ever, but I do think it's a good time to look to take profits where stocks have rebounded too far, too fast off those April lows. April 7th on the Morning Filter, which is my weekly podcast, is when I had officially moved to an overweight. So at this point, I just don't see the tailwinds to really continue to keep pushing the market that much higher here in the short term. You were talking about the E's earlier. When we look at the U.S. economic growth, our economic team expects the U.S. economy to slow sequentially, for the next 3 quarters. Of course, we have, the tariff negotiations going on. I think it's really going to be all about what China. China, of course, is not going to roll over on these negotiations. I think that's going to be hard fought. Not getting a tailwind from long-term interest rates. They're still kind of in that trading range in the mid-4s. Inflation still moderate, but again, that's going to come up later this year as the tariffs, start to hit. And for now, I think the Fed's on hold. So again, I'm not seeing those tailwinds really to get the market to continue moving up that much more. So good time to take some profit taking, but then also, as you talked about earlier, move into some of those, low valuation stocks.
Lou, what do you make of this argument? David saying, listen, looking a bit stretch here.
Yeah, I'm a bit more aggressive all-in kind of guy, but I can't argue with you. Those are definitely concerns. It's those traditional wall of worry that we have to climb. But I'd agree. Look, if you're taking profits here, I always come up with the conundrum of what do you do once you've taken the profits? So to your point, we were talking about earlier, you got to find the opportunities. Where are you buying value in this market? We've talked about, on a sector basis, energy looks really attractive. And it's the missing link to the AI growth boom. If we don't have the power to power, pun intended, the chips that are going to lead to productivity gains for AI, we really can't move without that. So you need to see energy pick up at some point. But again, I'd be curious, David, in your universe of coverage here, as you tell people to take profits, you had a great call on and getting in. Where do you see value in this market? Is it small caps? Is it certain sectors that are interesting to you? Is it an asset class?
It really just depends on the type of investor you are. I mean, looking at positioning, we like value stocks. Value stocks still trading at about a 6% discount overall to our fair values, but Growth stocks getting very overextended. They're trading at a composite at 15% premium. The last time they were trading at that much of a premium was beginning of this year when we had also thought that they were overextended. That was, of course, before DeepSeek, hit the headlines, forcing all those AI stocks, to start selling off. The only other time growth stocks were at a higher premium was at the very beginning of 2022, back when we were actually underweight equities going into that year, and of course had the market sell off. And we do still like small caps. Small caps overall trading at a 16% discount to fair value. I would just caution investors, small caps is going to be much more of a longer term investment than a trade. Historically, small caps will do well when the economy has already slowed or maybe even gone to recession, bottoming out and coming back. Usually when longer term interest rates are coming down. You also would want to see the Fed cutting rates. That's not the environment we're in now. I don't think that environment probably will happen until late this year or beginning of next year. But I do think once small caps start to move, they're going to move quick. So I think you need to be invested in them now before you miss that movement.
I love hearing that because I was the lone crazy man about 6 months ago banging the table on small caps. But that's it. When you're contrarian, you want everyone else to start coming to your side. So glad to have company on this.
David, given the backdrop, the environment there, what sectors do I want to be overweight here?
Well, first of all, communications still the most undervalued sector according to our numbers, trades at a 13% discount. Now, a lot of that is going to be Alphabet. Alphabet, of course, based on its market capitalization, does skew the price to fair value for that entire sector. Alphabet's a 4-star rated stock at a 19% discount. We think the market is just overly concerned about the DOJ lawsuits and the threat of AI and the potential for breaking it up. In fact, our analyst has done a sum of the parts analysis. He thinks that stock is worth at least as much as where it's trading now, even if they were to be forced to split up. Having said that, the company's really still just hitting on all cylinders. If you look at the numbers, search, cloud, YouTube, all doing very well. If you take a look at the Mag 7, that's the only one that we still think is undervalued today.
Another name on your radar, David, Verizon. Walk us through that one.
Mm-hmm. Yeah, Verizon is a name we've actually been very constructive on for quite a while. About a year and a half ago, our analyst team started noting that they thought that the wireless industry would start acting more like an oligopoly over time, that they would compete less on price and start competing more on other kind of non-pricing items, and that would allow them to start raising their margins. We have seen that. It's a 4-star rated stock at a 20% discount, provides a really healthy dividend yield of 6.3%. And when I look at our model, the forecasts I think are pretty modest. We're only looking for like 2% top line growth, looking for only 6% earnings growth, over the long term. But the company's only trading at a 9x forward PE. We're seeing some good free cash flow expansion there. So I think that one's very attractive still.
What about Tesla, David?
Yeah, unfortunately, Tesla we still think is overvalued at this point. It's a 2-star rated stock, trades at a 26% premium to our fair value. Just taking a look at the deliveries in the first half of the year, I think those were disappointing. Our analysts think that really indicates that the product lineup has really kind of saturated the EV market at this point. I think the key for Tesla is going to be their affordable vehicle launch. That's not going to be at this point until later this year. And just to put that into context, we assume that Tesla is going to be able to ramp up to 1 million vehicles annually sold by 2028. That's going to be at least a third of the total vehicles by then. So really, that is the key for the next couple of years. Other than that, we do think there is some long-term upside from robo-taxis, but again, that's probably not going to launch for a few more years. So that's not necessarily a short-term catalyst.
David, always great to see you and to have you on the show. Enjoy the weekend.
All right, thank you. You too.
Well, with more Magnificent Seven stocks on deck, investors watching several key things. My colleague Julie Hyman spoke with Nancy Tangler, who is CEO and CIO at Laffer Tangler Investments.
It was pretty extraordinary yesterday to see Trump and Powell there with their hard hats on, Powell correcting Trump on some of the renovation figures in real time, and the two talking about interest rates a little bit. Now, I know that you, for a while, have not been on the same page with the Fed in terms of interest rate policy. Do you think that they should be cutting next week?
Well, I don't think they will, Julie. I think this Fed has demonstrated that they've been wrong at every turning point. And, if we did that in our business, and this well, we would be out of business. So I actually think the most constructive thing that's come out of this is Secretary Bessent saying, I'm going to just review the entire institution because I feel like they've lost their way. You've got 450 plus PhD economists plugging into models they don't use. You got the Fed driving through the rearview mirror and then consequently being late and wrong at every turning point.
Well, Nancy, can I get you to pause there? What says that they're so wrong and so late? The U.S. economy, or maybe you don't think so, the U.S. economy seems to be chugging along okay, right? So what's so terrible about what they've done?
Yeah, well, so they were wrong. He was wrong in 2018, and we got the 2018 bear market. He raised rates in the face of tariffs because he thought they were inflationary. They weren't. He was wrong in 2020 by letting rates, and 2021, I'm sorry, by letting rates, by letting inflation accelerate while he kept talking about transitory. He cut in the fall 100 basis points, and the 10-year rose by 100 basis points. So that's the history. And then if you go to current time, what we're hearing from, the housing, the home builders as they report is that, this morning we heard from Reddit that 15% of contracts are being canceled. Now, we heard from D.R. Horton that 64% of their new home buyers were new home buyers. But what's happening is they're waiting. So the average age of a millennial home buyer is 38 years old. So we're locking out a whole constituency from housing. And I think that is something that has to be taken into consideration.
Okay, so you're saying you think that the dual mandate of the Fed needs to be reconsidered then if you think that they should be taking into account things like affordability?
Well, I think pricing is an important aspect. We've got inflation back to levels that are manageable. If you look at my analogy to the 1990s, what you'll see is that, it is possible to have robust stock price returns as we did in the 90s, coexist with higher interest rates and higher inflation. But we also had an environment where the affordability was there because wages were rising so quickly. We have seen wages rise, real wages, but wages, sorry, say that 100 times fast, real wages, but they haven't risen by very much, Julie. So, I may be fine, you may be fine, but this lower income cohort that lives paycheck to paycheck is being locked out of the housing market. And I do think that has to be a consideration overall.
So whether you think that the Federal Reserve sort of dual mandate and structural reasons for raising or lowering rates should be reexamined. Okay, let's put that to the side for a moment. Do you think that the Fed should be an independent entity of the executive?
100%. 100% I agree with that. And I don't like what the president's doing. I'm not advocating for hammering the Fed. I think that's left to people like me and the market and the bond market. But that's what we have. And we've had it before. Remember, Lyndon Johnson picked up his Fed chairman and threw him against the wall back in the day, trying to intimidate him. So I don't like it, but I think the Fed needs to reconsider looking backward and really being focused on tariffs when during the Biden administration, we spent something like $6 trillion and he wasn't at all worried about that, which really was the accelerant on inflation, was, profligate fiscal spending. So I just find the inconsistencies and the lack of humility a real problem because in our business, if nothing else, you have to be humble.
Consumer-facing stocks are falling out of favor with U.S. investors. Senior reporter Allie Canal joins us now with the Yahoo Finance Investor Playbook. Allie.
Hi, Josh. Yeah, Wall Street seems to be growing a bit more cautious on the consumer, especially lower income Americans. And that bifurcation, it's showing up in this week's earnings. So earlier this week, we saw Chipotle shares fall double digits after the company cut its full year outlook. Hilton dropped on weak U.S. room revenue. Hasbro flagged ongoing pricing sensitivities. And even American Airlines and Southwest, both those airliners warning on soft domestic travel. Now, excluding the airlines, many of these names fall under the consumer discretionary sector. And despite the S&P 500 trading at record highs, up around 10% on the year, consumer discretionary is barely positive. That actually makes the sector one of the worst performers in 2025. And then on the flip side, you have companies catering to wealthier households like JP Morgan, Amex. They're holding up much better in this environment. And to that point, we've seen sectors like financials, industrials, communication services, technology, those sectors continue to outperform. We heard from Bank of America, which said that their survey data showed that industrials and financials that actually drew the largest inflows last week, underscoring some of that investor appetite when it comes to these cyclical names with strong earnings momentum. And then what was the biggest outflow? That was consumer discretionary. So we're seeing this trade play out in real time. We talked to a few strategists about this bifurcation. Here's a little bit more of what they told us.
I still think that we have a bit of a K-shaped economy. Maybe that's another similarity, like the meme stocks being all the rage again, to what was happening in 2020, 2021, where you had this bifurcation. I think that we have a bifurcated economy right now, haves and have-nots, both at the consumer level and at the stock level.
The divergence between higher income and middle income and higher and lower income consumers is significant. That is what we're seeing in a very, very nuanced consumer market. This is a hyper promotional environment. To get people, especially lower income and lower middle income consumers, to spend money, you have to be out promoting. You have to be out with deals.
Yeah, so really interesting to see how this is playing out this earnings season. And the takeaway here is really that caution is rising around those lower income spenders. And until there's a bit more clarity on household demand, we may continue to see investors rotate into some of these higher income plays, at least for now, Josh.
All right. Thank you, Allie. Appreciate it. Time now for what to watch. It is a big week of data, so let's get you up to speed. Starting off on the earnings front, we're going to be getting a big batch of reports, including 4 of the Magnificent 7, Microsoft, Meta, Apple, and Amazon. Microsoft's going to kick things off on Wednesday, announcing results for the fourth quarter after the markets close. AI and CapEx, key focus for analysts this quarter, and they're expecting commentary about how AI is making the company more efficient. And moving over to the Federal Reserve, the Fed is kicking off its 2-day FOMC meeting on Tuesday and making its decision on interest rates on Wednesday. That decision will be followed by a press conference from Fed Chair Jerome Powell. Yahoo Finance will begin coverage on Wednesday at 2 p.m. Eastern. And taking a look at the economy, some fresh inflation data coming in with PCE, that's personal consumption expenditures. Economists forecasting both total and core PCE to tick up to 0.3% on a month-over-month basis. And finally, the July jobs report is capping off a busy week on Friday. Non-farm payrolls expected to drop compared to June to 110,000, while unemployment and hourly wages both tick up to 4.2 and 0.3% respectively.